All right, so despite the uncertain timing of the conclusion to the Iran conflict, many Wall Street purists, they're upset. They're upset that crude oil isn't much higher. It should be much higher than it is. And stocks, well, stocks, they didn't get slammed, right? Typically in this kind of environment, stocks get hammered. Now, even though the dynamics of oil prices are different now, of course, than they were in the 1970s, the bears still want to see a capitulation there. And of course, think about this. When it comes to the stock market, even last year with the tariff tantrum, we're going to pull up a table here, there was a 19% pullback. So you look at all these major conflicts, your average pullback is 16%. Again, last year was 19%. But my next guest says, you know, this is a period when investors can make many mistakes. So when it's over, but beware of dual-sided risk. I want to bring in Empower Chief Investment Strategist Marta Norton. So just in general, obviously, at some point, this will be over. Yep. You know, I've spent the last couple of weeks talking about wars, post-wars, markets rebounding, and I guess the tough part is living through it. What are you telling people?
Well, one thing that I think is really interesting is when we're in a period like this where the headlines are so alarming, I think the biggest risk comes down to behavior. And I think behavior can go in two different directions. It can go in the direction where people think every dip is a buying opportunity. And I really think that's—
This is your dual risk, yeah.
Exactly right. And so every dip, every price dip, a buying opportunity. And that doesn't necessarily mean that you're getting good value. And at the same time, there's that concern that people just over-rotate on geopolitical concerns, revamp their portfolios for something that is really a moment in time rather than a secular change.
The irony with that is, like, you know, even with the Federal Reserve, I've talked a lot about this tactic of looking through.
Yeah.
Right. You know, they have to be very careful of adjusting policy.
Yes.
That's going to kick in 6 months from now when maybe the issue is already over.
I mean, I think that's a really important point, and their own research makes that point, that you can have an oil price spike that, if we're in the Ukraine situation, we see in 6 months' time has reversed itself, and we know monetary policy works with long and variable lags.
Let me ask, though, about the way I started this. The fact that oil, for a split second, we got to 119, and then we went to 80.
Yeah.
But the fact that crude isn't 140, 150 right now, because I saw headlines last week of 200, you know.
Right.
And that the market didn't sell off 20%.
Yeah.
Is that a good thing or a bad thing?
Well, I think one thing that people are raising that really helps to feed this sense of uncertainty is that we're not quite sure if the physical market and the financial markets are aligned in what's really happening with natural gas, with oil. And so I think that's something that we're going to have to continue to monitor.
So you already kind of alluded to this, but in your note you said watch valuations, not stock prices.
Yeah.
And then you say calling all value investors, technology might be the place to be.
Yeah, listen, I'm excited about AI long term. I think it's this huge secular boom, but I want to get it when the price is right. Last September, the price was not right. But when we look at how members of the Mag 7, so think—
here
we go.
These are your forward PE ratios.
Yep.
I don't know if you'd ever tell you, NVIDIA, the biggest, hottest company in the world, trading at 15 times, Micron at 4 times, Microsoft less than 20 times, Broadcom less than 7. It's nuts. I mean, really, really is nuts. And I mean, that's typically where value investors begin, right?
I think that if you're looking at the full range of outcomes and you're worried about financing and those types of things, these valuations are taking those concerns into account. And so that means it's a much better time to start getting invested, in my view, in this area.
I'm going to ask you about another great point you had on the 60-40 portfolio.
Yeah.
You know, I haven't been a fan of it for a long time, but a lot of folks came into this year saying, hey, it was down. Typically, following down years, the 60-40 portfolio, it goes crazy. It's if you hold it for, you know, the next 12 months, the next 3 years, the next 5 years.
Yeah.
But maybe it seems to me you feel like maybe we're not following the script this time.
Well, I think what I notice about the 60-40 is it's a very simplistic portfolio, right? And it doesn't allow for a whole lot of range of asset classes. What I would say is a lot of the complaints around the 60-40 really focus on the 40. And so if you're in an inflationary environment, I think you can get disappointment in fixed income. But you can also get some pretty good defense if growth or earnings concerns come into play. So what I encourage investors to do is not abandon the 40, just have the right expectations for it.
What about the configuration? Some are saying a 60-20-20. Commodities are playing a bigger role. Some folks think we may be the beginning of a commodity super cycle. We saw what gold has done. Could there be substitutes in there to counterbalance equity exposure.
Yeah, I've heard that as well, that we're at the beginning of a commodity super cycle, really across a number of different commodities, some of it relating to the AI play. I think commodities deserve a place in the portfolio, but I think you should realize that they're not equities and they're not fixed income. So you have to think about them in kind of a way that's true to their own nature.
Great stuff, Marta. Thank you so much.
My
Appreciate it.
pleasure.